यही होता है। सी
हाँ.
मतलब आप ना स्पीकर शेयर होल्डर्स का जब हम लोग सेशन
Good evening
ओपन
and
करेंगे
welcome to you
उससे
all.
पहले आप उनको बोलोगे कि
I'm sorry
द
that
स्पीकर शेयर
we are
होल्डर्स
late
कैन
by
आस्क द क्वेश्चन, और
few
वहीं पर
minutes due to
इंस्ट्रक्शंस
some
देके
technical glitch.
देन यू कैन हैंड इट ओवर
Extremely
टू
sorry
मी।
for the
आई विल
same.
कॉल देम वन बाय वन, उनके
So,
क्वेश्चंस ले
uh,
लेंगे।
welcome
देन यू
you
कैन
all to
रिप्लाई,
the
द मैनेजमेंट कैन
28th
रिप्लाई
series of
एंड देन इट
webinar
कंक्लूड्स। ये 15
for
मिनट्स वाली बात हम ऊपर ही
under
लिख
the
देते हैं,
aegis of
नीचे नहीं डालते हैं,
Committee for Members in Practice.
बिकॉज मीटिंग खत्म हो जाएगी तो वी कांट
The
स्पीक
topic
इन
for the
एट
day
दैट
is
टाइम।
taxation of
ओके,
non-residents
फिर मैम जो
and
अपना
TDS
क्वेश्चन
under
आंसर्स
Section
का जो
195
सेशन
of
है ना,
Income
वो
Tax
जब
Act
एंड होएगा।
and capacity building initiatives of CM. The speaker of the day is CA Gaurav Garg, who hails from Delhi. Let me give you a brief introduction of his. C. Gaurav is a partner of SGPM and Associates and has also served Northern India Regional Council of ICAI as chairman for the term 23-24. Also, he was a chairman North India CA Students Association for the term 21-22. C. Gaurav did his schooling from St. Margaret's Senior Secondary School, Prashant Vihar, Delhi, Bachelor in Commerce Honors from Sri Guru Gobind Singh College of Commerce, Delhi University in 1999 to 2002, and qualified CA final exams in 2004. He has worked with Deloitte Haskins and Sells and RSM and Company in past, and now he's a partner in a Delhi-based CA firm, SGPM and Associates Chartered Accountants. His clients list primarily includes Indian listed companies and M&Es operating in India. CA Gaurav has co-authored a book, Multilateral Instrument and Appeal. He's regularly on various platforms and has delivered more than 700 lectures till now on transfer pricing, non-resident, taxation, and corporate taxes. Last year in May 2023, Gaurav has been awarded Alumnus of the Year 2022-23, awarded by Sri Guru Gobind Singh College of Commerce. With this brief introduction, now I hand over the as to CA Gaurav. Please go ahead, sir.
Thank
Please.
you, CA Love Tamraji. A very good afternoon to all of you, to all the participants from across India. Indeed, I'm thankful to the leadership of the Committee for Members in Practice for giving me this an opportunity for sharing my views and thoughts on one of the most interesting topic in tax, that is non-resident taxation and TDS under Section 195 of the Income Tax Act. Just to, I'm not sure, how the participants will communicate with us, whether we're going to get some questions, or if I ask the question, whether they can respond or not. If someone from a tax support can help me on this. Anyone, Love, are you aware that if we ask question, whether participants can answer or not?
Yeah, we can go. Yeah, please go ahead. They can put up their questions and you can answer them. Or we can also, first you should deliver your lecture. Later on, we can keep for say 25, 30 minutes or 15, 20 minutes for answering the question answer session. So if any of the listeners have any of the doubts, they can clarify their doubts within those 15, 20 minutes. So you please go ahead.
Okay, sure. So we are discussing topic non-resident taxation and TDS under Section 195. Both are very interrelated. As far as Section 195 is concerned, it is primarily a machinery provision. If some transaction is taxable, then it falls under the provisions of 195. That is, one is required to deduct the TDS if the transaction is taxable. But yes, we have Section 195 subsection 6, which requires that the taxpayer should submit certain forms, Form 15CA, CB. So there may be a cases wherein even if the transaction is not taxable, he still needs to follow Section 195 subsection 6. Barring that, Section 195 is applicable if transaction is taxable. Now, question comes, how to decide the taxability of a transaction? So let me share my PPT with you. Hope my PPT is visible.
Yes, sir, you are very much visible.
Yeah. So just to, before we move on to the presentation, just to give you the background. Broadly, there are three systems of taxation which are followed across the globe. The first system of taxation is residence-based taxation. That the country wishes to tax their residents. And they will define that I'm going to tax all the income of residents or some certain income of residents, and they might give certain exemptions also. This is called residence-based taxation. Then you have a source-based taxation. Under source-based taxation, whether you are a resident of that country or not does not matter. But if you have a source or if you have generated an income from that country would like to collect a tax from. And third system is there could be mix of both residence and source-based taxation. That either you are my resident or you are having a source, I'm going to collect a tax from you in both the scenarios. Now, India follows the hybrid model of taxation, that is wherein it combines the residence and source-based taxation. And we have section 5, which suggests that under, if you are a resident, what kind of income would be taxable? If you are a non-resident, what income would be taxable? And if you are a resident but not ordinary resident, then what type of income would be taxable? So as far as residents are concerned, we call it, their global income is taxable. Global income in the sense whether income accrue or arise in India, income deemed to accrue or arise in India, income received or deemed to be received in India, or income accrue or arise outside India. All these cases would fall and under the resident taxation, and resident needs to pay tax on all such incomes. However, as per non-residents are concerned, the section is slightly different. It says, subject to the provision of this act, the total income of any previous year of a person who is a non-resident includes all income from whatever source is derived, which is received or is deemed to be received in India in such year by or on behalf of such person. So received or deemed to be received in India. Then it further adds accrue or rise or is deemed to accrue rise to him in India. Now, the global income of non-resident is not taxable. What is taxable? Whether it is received or deemed to be received in India, or it accrues or arise or deemed to accrue or rise in India. Now, this deemed to accrue or rise in India, deemed to accrue or rise in India is given in section 9. So we need to read section 5 and section 9. And if something falls under section 9, then also it is covered within the scope of total income of non-resident. Explanation 1 says that, if you have considered something on an accrual basis, you will not going to tax the same again on the received basis. Explanation 2 says, for the removal of doubt, it is hereby declared that the income which has been included in the total income on the basis that accrue or rise and deemed to accrue or rise to him shall not be again included on the basis it is received or deemed to be received in India. Explanation 1 says income accruing or rising outside India shall not be deemed to be received in India within the meaning of this section by reason only of the fact that it has taken into account in the balance sheet prepared in India. So sometimes you have a different entities and you merge the balance sheet. So explanation 1 takes care of the same. Explanation 2, which I referred wrongly earlier, that if we have considered some taxation based on the accrual, we're not going to tax it again based on the receipt. The question comes, what is the meaning of receipt? When we will say that income is received in India, or when we will say that income accrue or arise in India, we need to understand these two terms before we move on to section 9. But before we move on, just to again, create a background. Section 5 we have read with section 9, and then we can define the scope of total income. But then we have section 10. So there could be certain incomes which are exempt under section 10. So you need to watch out whether there is any income which is exempt under Section 10. For example, if there is a, there is a foreign currency account, and if you are receiving some money in that, interest in that, that interest is not taxable. That is exempt under Section 10. Similarly, we have a short stay for, certain type of people. If that is falling, then again, that income is not taxable. So we need to see Section 10 also. And then you have a income from salaries, income from house property, income from profit and gains of business profession, and so on. Basically a computational provision. And then we move on to Section 90, 91, wherein we give the relief for the double taxation avoidance agreement. So after going through 5, 9, 10, Section 5, 9, and 10, we also need to see whether there is any relief given under the DTA or not. If there is any relief given under the DTA, then you need to give that relief to that person. That is at the option of the taxpayer. Certainly, in order to claim the treaty benefit, one needs to submit tax residency certificate and Form 10F. We're going to see that section. And then comes your return, special sections, and then your returns, and then later on we come to Section 195. Section 195 is a section for withholding tax. Now this 195 comes at the end, if you see. Earlier you have a 5, 9, you have a Section 10, and then you need to give the DTA benefit, and then only we move on to Section 195. So that's how the scheme works. So before we conclude that whether, because the idea is, to understand, to develop a principle or concepts that when I need to withhold the TDS, if some client comes to you that, sir, I'm making a payment outside India, can you issue a 15 CB? According to me, there should not be any withholding. Generally, nowadays clients are smart. They do some Google search or some, search on a Meta AI or Chat GPT, and they will come to you. But how the tax system works, I think I always believe HI, that is human intelligence, always score over artificial intelligence, AI. So we need to have that strong HI so that we can use AI for our purpose. Otherwise, AI will going to use us. Now, coming back to Section 5, what is received? Now, let's say you are working abroad, you are a non-resident, and you earn an income, but you have a bank account in India. And you are receiving salary in India. Then this point A gets triggered that, you need to pay tax, because subsection 2 says that income received, and being the amount is getting credited to your account, it would be deemed that it is received in India. Not deemed, but it is received in India. But then there is another school of thought. Another school of thought says, and you will find the divided jurisprudence on the same. Another school of thought says, see, I received outside India. It's based on my orders or directions. The money simply got credited to my Indian bank account. I earned salary outside India. I directed them that, instead of paying me in US or in UK, whatever country you are, if you can credit the amount in India. So that school of thought says that I have already received money outside India and it is only getting credited in India, which has created doubts how to proceed, what could be the taxation in this case. If you ask me, and if I go by various jurisprudence, I think I will go by the school of thought, wherein if the amount is getting credited in the bank account directly from the payer, then I will say that money is received in India. And we have this circular number 13 of 2017, which says representation have been received in the board that income by way of salary received by non-resident seafarers for services rendered outside India on board foreign ships are being subject to tax in India for the reason that salary has been received by the seafarers into the NRE bank account maintained in India by seafarers. The matter has been examined in the board, of the income tax, provided that only such income of non-resident shall be subject to tax in India that is either received or deemed to be received in India. It is hereby clarified that salary accrued to non-resident seafarers for service rendered outside on a foreign ship shall not be included in the total income merely because the said salary has been credited in the NRE account maintained with Indian Bank of Seafarers. Now, this clarification is there, but this clarification is there only in case of seafarers. This clarification is not there in any other case. So in my humble view, when this clarification is there only in case of seafarers, that if even if they're working outside India on a foreign going ship, even if they receive a money in NRE account, it would be deemed that it is not received in India, and the circular number 13 applies. But not in other cases. So for all other practical purposes, if you have rendered services outside India, and the one who's supposed to pay you the money is actually directly paying money into your Indian bank account, then we'll say it is received in India. Now, as far as accrue or arise, these two words are very important. What is the meaning of accrue, or what is the meaning of arise? So accrue means, where we have done some action, where we have done some activity, wherein my rights to get the income is generated. It's like, the fruit is coming out of the tree. So where is the tree? From where the fruit is coming, from which the fruit is coming. So where there is a tree, where there's an activity, where there's an action, generally that place is called the place of accrual or the place of arise. Now, a very common example we can take. Let's say you are an exporter of goods. You are a manufacturer of goods in India, and you have a customers abroad. You have a customers in Middle East, you have customers in Germany, and certainly you have a commission agent. You are exporting goods outside India. You need to pay, let's say, 5% or 2% of the exports value as a commission to the commission agent in UAE. Now the client comes to you that during the last 6 months, we had a sales of 100 crores. And now I need to pay, let's say, 2% commission to my commission agent in UAE. And the commission rate is 2%. So 2 crores, we need to transfer money. So whether TDS should be deducted or not under section 195, that is a question you will be facing. So what is your view? I'm not sure if you can answer or not. Is there any possible scenario from where we can see what is the answer of audience? So you can write down. Love, is there any way from where we can see what is the answer from the audience in this question?
Audience, please put your answers in the chat box.
But we can only see there are 4 participants, Love, in this.
Yeah. I'm not very much sure whether all the participants are here or not, or it is being displayed or not, because all the 4 are from the CMP committee itself. Yourself, myself, and 2 members from the...
Yeah, so if technical support team can guide us or someone from a committee can help us. Is there anyone from the technical support?
Let me call them, please.
Anyone from the committee?
Hold
Okay, so
for a
let
minute.
me...
Yeah.
Love, you try over the phone. Let me continue with the presentation.
Okay, yeah, please go ahead.
So I will suggest, I will keep on asking such questions, and if you can, just think in your brains, or if you can write on a piece of paper, so that I may not be able to get your answer, but yes, you are participating in the discussion. So now when you need to pay commission to the non-resident commissioner outside India, the question comes, should we deduct the TDS or not? And the the question that we indeed need to answer whether that income is chargeable to tax in India or not. And for that, we need to see section 5. So whether it is received in India, answer is no, we are transferring money outside India. Whether it is accrue or arise in India, question comes whether it is accrue or arise in India. Answer is where the activities have been performed. Activities are performed outside India. And if activities are performed outside India, then it means the income is accruing outside India. It is not accruing in India. So when we are paying commission to the non-resident, it is not received in India, it is not accrue rising in India, hence it is not taxable in India. Simply, you can say it is not taxable under section 5. Yes, certainly we need to see whether it is falling into the scope of deemed to accrue rise or not. But yes, it is not received or deemed to be received, it is not accrue. So it is not falling under this scope. So now the only thing which we need to see whether under section 9 it is falling or not, but it is not falling under section 5. Similarly, when you are taking a technical service from someone and you are paying money outside India, because that person has rendered services outside India, it does not accrue in India. So it will not fall under accrue or arise. And that's why we have section 9, which defines deemed to accrue or arise.
Sorry to interrupt you. Sir, we have around 500 participants who are participating in the section. The one link which has been provided to us is only for internal purpose, whereas more than 400 to 500 participants have already joined the.
Okay. So, but we cannot see their, reply.
Yeah.
For example, the question which I'm asking. Okay.
Yeah.
No worries. No worries. So now we are clear that, we need to read section 5 with section 9. We'll going to see section 9 in detail. So it is just, trying to create a background. Then we have section 90. Section 90 is a double taxation relief. We have subsection 2, which says where the central government has entered into an agreement with the government of any country outside India or specific territory outside India, as the case may be under subsection 1 for granted relief of tax, then shall apply to the extent they are more beneficial to the SSC. So clearly section 90 subsection 2 says that if the treaty provisions are more beneficial, in that case, such treaty provisions shall apply. But there is an additional condition given under subsection 4, that in order to claim the treaty benefit, a resident of such country, that is a foreign country, must submit tax residency certificate. Now, if you are not able to submit tax residency certificate, that is, if your recipient abroad is not able to submit tax residency certificate, in such case, you cannot give him the relief there in the DTA. And how the system works? First, the payer needs to withhold the TDS. So at the time of deduction of tax or at the time of withholding of tax, that is under section 195, one will see whether we can give the treaty benefit or not. For that, you must have TRC. Secondly, when you are filing a return, the non-resident is filing a return. At that time also, he can claim the treaty benefit if he has got the tax residency certificate. So there could be a scenario that at the time of withholding of tax or at the time of deduction of tax under section 195, TRC was not available. So in such case, the payer will not, or the payer shall not, in my view, give the treaty benefit. They need to deduct the tax under the Act, as per the normal provisions of the Act. But later on, when the recipient, that is a non-resident, is filing the income tax return, and if he has got the tax residency certificate, he can very well claim the treaty benefit. Now, in addition to TRC, one also needs to file Form 10F. So there are certain information one needs to give under tax residency certificate. And if that information is not available, if any of the information is not available, then Form 10F must be also given by the non-resident to the payer. Now we need to file Form 10F online. So now there is a e-filing of Form 10F. But these two documents for all practical purposes are very important. Generally, you will find that one or another information is missing in the TRC. But yes, certainly go through the TRC and take 10F, and then only one can give the treaty benefit. Now coming to section 195, and then we will go transaction by transaction. At that time, I would be using section 9. Next, we will be having discussion on section 9. Now, what section 195 says? Any person responsible for paying to a non-resident, not being a company or to a company or to a foreign company, any interest, not being interest referred to in section LB, LC, LD, 194 LB, LC, LD, or any other sum chargeable under the head provision of this act, not being income chargeable under the statutes. So 195(1) is not applicable on salaries. It is not applicable on LB, LC, LD interest because they have specific provision. Shall at the time of credit of such sum, income to the account of the payee, or at the time of payment thereof in cash, or by the issue of check or draft, or by any other mode, whichever is earlier, deduct income tax thereon at the rate in force. Very interesting section. Practically what happens when client comes to you, when a taxpayer comes to you for 15 CB, he comes to you when he wants to make a payment and banker says, boss, without 15 CB, I will not allow you to make a payment. Correct? This is what happens. So there could be a scenario that, let's say, he has deducted a TDS in the month of January, and he comes to you in the month of August for the payment, that I need to make a payment. Can you issue a 15 CB? You says, boss, I need a tax residency certificate if you wish to claim a treaty benefit. He says, sir, can you wait for a month? I will get it. They have already applied. Now they give you tax residency certificate in the month of September, which means in January 2024, TRC was not available. And both TRC and 10F are given to you now, today. So what should be the rate in force? That is the question. It says deduct income tax thereon at the rate in force. And now let's say the assessee has already given a treaty benefit in January. Assessee has already given a treaty benefit in January without having tax residency certificate. I think in my view, the benefit can only be given once you have a tax residency certificate, which the taxpayer was not having in January 2024. So in my humble submission, herein taxpayer has defaulted. At the time of payment of sum, there is a TD, this certificate was available, but not at the time of deduction. So 195 says, shall at the time of credit of such income to the account of the payee, or at the time of payment thereof in cash, or by the issue of check or draft, or by any other mode, whichever is earlier. Highlight these words, whichever is earlier. So means when this 190, when section 90, subsection 4 and 5 will come into the play when you are deducting the TDS. So that is how one should, in my view, take a position that when you are issuing 15 CB, so not at the time, if the payment comes later at the time of booking, booking is done in January, payment has been made in October or maybe in September or August. So one needs to see when these provisions are applicable. These provisions are applicable in January and not now. So now only subsection 6 of 195 is applicable. Subsection 1 was applicable in January. So hope I am clear on this. Further, if we read it again, it says any other sum chargeable under the provision of this act. Sometimes we get stuck only on the word any other sum. So we need to deduct TDS on any other sum. No, not any other sum. Any other sum that is chargeable under the provision of this act. So one must that what the amount which I'm paying to a non-resident should be in India. Then only one needs to withhold a TDS under section 195 in a simple language. If I'm paying an amount which is not chargeable to tax, no TDS is required. Provided that in case of interest payable by the government or a public sector bank within the meaning of clause 23D of section 10 or public financial institutions within the meaning of this clause, deduction of tax shall be made only at the time of payment thereof. So they have specifically said at the time of payment that needs to be done by the issue of check or draft or by any other. But we'll stick to this, any other sum chargeable. Now, what are the professional opportunities? How you see 195 is also matters a lot. So is it a simply a issuance of form 15 CB, simply a certification that you will verify the data correct and then you will sign it and stamp it and close the matter? In my view, it is an opinion. Opinion whether the amount is chargeable to tax or not. What should be the tax rate? I think that is a larger portion. Rest all comes from accounts. But in order to conclude, you need to know the facts. You need to understand the act. You need to understand the DTA. And then only you can say that, yes, this is the rate I'm applying. Though it's a very thin certificate, but yes, it holds a very valuable opinion. Certification is certainly there. You're going to issue the certificate. That is no doubt. Application for lower withholding certificate, you can always apply under section 197, 195 too, that you need a lower withholding certificate. Consequences for business: banks will not allow payment without certificate under 15 CB. There's a disallowance of expenditure. There could be a tax demand. There could be penalty. There could be prosecution also. So very important section 195. Objective and unique features of section 195. Circular number 152 clearly states, a very old circular, even before we were born, 1974. Imposes a statutory obligation on any person responsible for paying to non-resident. Tax due from non-resident person is collected at the earliest point of time. Unique features: no exemption for personal payments. Even if you are making some personal payment, then also it gets captured under section 195. So let's say you are building a home and you hire some consultant, and now you're making a payment to that consultant. So one may say it's a personal payment. Should I withhold the TDS? The answer could be yes or no, but certainly that payment needs evaluation under section 195, read with section 5 and 9 and 90. So now when you are making a payment to an architect, for that matter, let's say for designing, you're making a payment, that is a technical service which you have received under section 9. And accordingly, that income become taxable in the act. It is a different matter. It may not be taxable under the DTA, but then you need to have that tax residency certificate of that architect from London. If you don't have that certificate, you cannot give the DTA benefit. So under section 9, it will become taxable. And if you have not withholded TDS, you are the representative SSC. So the government will going to collect a tax from you in that case. So to all my seniors and friends watching this discussion, under 195, whether it's personal payment or payment related to businesses, both are covered. No threshold criteria. Even if transaction value is of 10 rupee, then also the provisions apply. No relaxation based on the legal status of the payer, whether payer is a partnership firm, whether it's an HUF or a company. individual. There is no such relaxation. Multidimensional, you need to understand the act, you need to understand the DTA, and now you need to understand the multilateral instrument also. But now we have a, if you go to the treaty, the treaty takes care of the MLI. The updated treaties take care of the MLI. So now you will find that we may have a two documents, original treaty and modified treaty. Generally, it is known by the name of synthesized text. Uske andar, on that you will find that whatever the MLI provisions which both countries have agreed, they are forming part of that DTA. So relevant sections around 195 we have already discussed. Section 4 is the charging section. Section 5 is the total income, scope of total income. Then we have 9, income deemed to occur in India. 197, 201, 201A, 206 AA. And yes, certainly we have section 90. And how 195 is placed, scope and conditions are given in 1, applicability by payer to assessing officer, application by payer to the assessing officer under 2, application by payee to assessing officer under section 3, subsection 3, validity, if the certificate is issued, the validity of period is given in subsection 4, power of CBDT to issue notification under subsection 5, and then furnishing of information by the payer under subsection 6. These are some of the important provisions of 195. So once again, it says any person responsible for paying to a non-resident, any interest not being interest referred to in subsection LB, LC, LD, or any other sum chargeable under the provision of this act. So now if you are paying salary to non-resident, then salary to non-resident comes under section 192 and not under 195. So when you are making payment of salary to non-resident, you are not required to have Form 15CB, because that is the requirement under the subsection 6 of 195 and not under section 192. So you will going to do a computation as per section 192 and withhold the tax if you are making a salary payment to a non-resident. This we have already seen shall at the time of credit of such income to the account of the payee, or at the time of payment thereof in cash, or by the issue of check or draft, whichever is earlier. So it is applicable primarily on any other sum chargeable under the provision of this act. Any other sum means other than these interest and salaries. Explanation 2 clarifies that provision of this section are also applicable wherein payer is non-resident. So if there is a transaction between non-resident to non-resident, then the provision of 195 also applies on the non-resident. Let's say if non-resident is making a payment, let's consider a scenario. Very interesting case. Let's say you have got a company in India, company abroad. We have got, let's say, a subsidiary company in India and headquarter abroad. We have a headquartered in UK. Now, for some services in India, the UK company hires a professional and pays a consultancy charges to said professional. For the sake of administrative convenience, the professional enter into an agreement with the UK headquartered company. Maybe, let's say, for £10,000. Now, after making a payment to that consultant, the foreign entity raises an invoice on the Indian entity without adding any mark. And Indian entity pays to such UK headquartered company. Now the question comes, who needs to deduct the TDS? Whether it's the Indian company needs to deduct the TDS, or is the UK company which needs to deduct the TDS, or whether there would not going to be any withholding. One may take a position that it is a reimbursement transaction without any mark. And being it is a reimbursement transaction, there should not be any TDS. If it is a reimbursement transaction, there should not be any TDS. Does it mean that UK entity now needs to withhold the tax? Because explanation 2 is applicable. As per explanation 2, section 195 is also applicable on the non-resident. So if non-resident is making payment to a non-resident, and such sum is chargeable to tax in India, then that UK resident needs to withhold the TDS. We'll park this question. Let's move on. But yes, things are becoming interesting, I hope. Now, just to see what 195.1 and 195.2 says, and then we'll move on to a very interesting situation. So whenever I travel and give session on, this non-resident taxation, that is a very debated position. So, but we'll discuss. Any person responsible for paying to a non-resident, not being a company or to a foreign company, any interest or any other sum chargeable in the provision of this act. This is what is written in subsection 1. Now, subsection 2 says, where the person responsible for paying any such sum chargeable in this act, whole of such sum would not be income chargeable. In the case of the recipient, he may make an application to determine the appropriate proportion of such sum so chargeable. And upon such determination, tax shall be deducted under subsection 1 only on that proportion of the sum which is so chargeable. So subsection 2 says, in case if you are making a payment, you are not aware, that you feel that whole sum is not chargeable, then you can make a application under section 195(2) and ask the officer. Officer will tell you, okay, out of 100, how much you need to withhold the tax. You need to withhold the tax on 20, you need to withhold the tax on 80, on how much portion you need to withhold the tax. So the question came, specifically in case of capital gain, this is a big issue. Let's say Gaurav, a resident of Delhi, purchased a residential house from Rudra. Property is located in Faridabad and Rudra is a non-resident Indian and now living in Singapore. Total transaction value is 1.75 crores. Gaurav wants to deduct tax on full amount. Now, as per revised rate, one may say 12.5 or 20, whereas Rudra, let's put it 12.5. Whereas Rudra is insisting not to deduct any tax as he has bought a residential house for his parents in Delhi worth rupees 2 crore only in the last. Question comes, should we give him some benefit which is there under section 54, or we should simply deduct TDS on the whole amount? Or let me rephrase. Should we deduct TDS on the full amount, that is 1.75 CR, or should we deduct TDS on the capital gain? We should compute TDS. We should compute capital gain and deduct TDS, or should we give the benefit of section 54 because he has invested in the residential house property? So what is your view? My presentation was visible enough? No. Hope I'm clear on the question. That the total transaction value is 1.75 CR. Let's assume capital gain is 25 lakhs. And Rudra has already invested 2 crores in the residential house. So the question is, in this case of capital gain, should we deduct TDS on the full amount, that is 1.75 CR, or on the amount of capital gain, or we should not deduct TDS at all? You may take a minute to think over it. So let's see, what courts has to say in India. Let's read G India. The obligation to deduct tax at source is, however, limited to the appropriate proportion of the income chargeable under the Act, forming part of gross sum of money payable to the non-resident. So Apex Court in case of GE India Technology said it is limited to the appropriate proportion of income chargeable under the Act. This obligation being limited to the appropriate proportion of income flows from the word used in section 195(1), namely chargeable under the provision of the Act. So going by this para, one need not withhold the tax on the entire portion. One only needs to withhold the tax on the capital gain amount portion. And that too if capital gain is chargeable to tax. If capital gain is not chargeable to tax, you are not required to withhold any tax. The application of section 195 subsection 2 presupposes that the person responsible for making the payment to the non-resident is in no doubt that tax is payable in respect of some part of the amount to be remitted to a non-resident, but is not sure as to what should be the proportion so taxable, or is not sure as to the amount of tax to be deducted. So there could be two cases. One, when you are making a payment, out of 100, 30 is taxable, 70 is not taxable, or 100 is not taxable. Or you are aware your entire 100 cannot be taxed. Only a portion of 100 needs to be taxed. So if you are not sure that, though you are sure that 100 should not be taxed, but how much needs to be taxed, you are not sure, then you fall under subsection 2. But if you're sure that out of this 30 needs to be taxed, then you can straight away apply the para 1 of G India Technologies. In such situation, he is required to make an application. So in which situation wherein he is not sure? It is only when these conditions are satisfied and application is made to ITU TDS that the question of making an order under section 195(2) will arise. We later on got instructions also from the department, and what instruction says? The AO shall determine the appropriate proportion of the sum chargeable to tax as mentioned in subsection 1 of section 195 to ascertain the tax liability on which deductor shall be deemed to be assessee in default under section 201 of the Act. So not on the entire portion. So if the intention was key, one needs to deduct the TDS on the entire portion of the transaction, then you would have become the deemed assessee in default on the entire portion. But if we read instruction 2 of 2014, it clearly says a certain tax liability to which deductor shall be deemed to be assessed in default. So not on the entire portion. The appropriate proportion of the sum will depend on the facts and circumstances of each case, taking into account nature of remittance, income component, therein or any other fact relevant to determine such appropriate proportion. So now each case is certainly independent. We need to see how these provisions will apply. But one thing is clear, that 195(1) do not pushes taxpayer to deduct TDS on the entire portion. 195(1) clearly says the sum which is chargeable to tax, only on that portion one needs to withhold the TDS. I hope I'm clear. And then we got a Bangalore tribunal judgment, which again said the same thing. So I took this fact from this judgment wherein the tribunal gave the section 54 benefit. This says now because the entire sum was invested, no TDS was required. This another case study is on 195 vis-a-vis 192. Dutch holding GmbH deputed Mr. Paul to Indian subsidiary Asia Manufacturing Private Limited based out of Faridabad, Haryana. Mr. Nitesh F&A head has approached you to know the tax implication under chapter 17B of the Act regard to salary payment of Mr. Paul. It's a very common transaction. Generally, you will find, let's say there is a 100 rupee salary. Some portion is paid outside India, maybe 40%. And let's say 60% of the portion is paid in India. So on 60%, should we deduct TDS? If yes, under which section? Whether we should also include that 40% into account for withholding the TDS? And what would be the situation when the foreign company will raise a reimbursement invoice on India for that 40%, whether one needs to deduct TDS or not? So friends, in this case, the entire sum of money is taxable in India and it will go to section 192 and TDS needs to be deducted under section 192. If we say that the employer of Mr. Paul is Indian entity, in that case, the TDS would be deducted under section 192 by an Indian entity. And on the reimbursement of this salary, no TDS. We're going to discuss that reimbursement portion also, but for the sake of understanding how it works. But let's say, instead of concluding that India is an employer of Mr. Paul, in this case, employer still is the Dutch holding company. And if employer is still the Dutch holding company, then it is not the employer-employee relationship between Mr. Paul. Then it is a technical service. Then we need to see whether it is a technical service from a Dutch company to an Indian company through Mr. Paul. And whether Mr. Paul is forming a permanent establishment in India or not. And if, so now the case would be scenario number one. We are saying that Indian entity is not an employer. Employer is a Dutch company. Under this, there could be two scenarios. One, there is a permanent establishment. Two, there is no permanent establishment. If there is a permanent establishment, then we need to see whether the amount which we are paying, 40 plus 60, 100, is the income to permanent establishment or not. If answer is yes, TDS would be deducted as if it is a TDS for a business income. If answer is no, somebody concludes, no, it is not a permanent establishment or there should not be any taxability, there is no markup. When we go to 197 and say 100 rupee ka expense and there is a 100 rupee income, no profit, no taxability. But this can only be done, if one's take a route of 197. It is also applicable 195.1 we have just discussed. If you are sure it is not chargeable, you can always take a position. But yes, it is safer to go for a lower withholding certificate. The second position could be, though there is no P, but can it be said to be fee for technical services? If yes, then whether there should be withholding. So now, when we are seeing it is not a salary, but a business income or an FTS, then TDS would be under section 195. But if you are saying it is a salary, TDS would be under section 192. Interestingly, now the Dutch holding company is making a payment to Mr. Paul. So now Dutch holding company, and if salary is taxable in India of Mr. Paul, then whether Dutch holding company needs to do a TDS under section 192, that question will come. So very interesting scenario. So one needs to be very sure, specifically in case of deputation, whether it is a clear deputation, that is, Indian company should be treated as a employer, or whether Mr. Paul, in this case, will going to form a permanent establishment of a foreign company in India or not, whether it will qualify as a fee for technical service. Now, few points to clarify. Section 195.1, any person, legal status of payer does not matter. Individual, HUF, everyone is covered. Is section 195 applicable on resident but not ordinary resident? What is your opinion? Whether section 195 is applicable on resident but not ordinary resident? What is your view? See, 195 is applicable on payment to non-residents. But here it is resident, so it is not applicable. Let's say Indian company making a payment to project of office of a foreign company in India. There could be interesting scenario. Let's say you have a project office in India of a foreign company. Foreign company has got a project office in India, and foreign company has also got subsidiary in India. Now, subsidiary company gets some project, and the project office is basically for that project. So client gives $100 to the Indian company. Out of that $100, Indian company outsources 30% of the portion to the project office. So $30 money after deducting some amount, let's say $27 goes to a project office in India. And the office of both Indian company and project office are in the same building. Let's say on the level A, we have an Indian company office. On the level B, we have a project office. So the question comes, when I am making a payment within India, but to a foreign company, should I deduct TDS under section 195 or should I deduct TDS under section 194J? What is your view? Whether we should deduct TDS under section 195 or we should deduct TDS under section 194J? Answer is, because it is a project office, payment to non-resident, TDS needs to be deducted under section 195. Indian company making payment to the agent of foreign company. You have an agent, foreign company has got an agent in India. That agent is a resident. Now you are making a payment to the resident agent of a foreign company in India. Again, whether 195 or any other provision of this act, which or any other 194J, 194C, let's say, assume it. So agent steps into the shoes of foreign company. So it is as good as making a payment to the foreign company that is non-resident, and section 195 would be applicable. What if someone is a tax resident in India and foreign country also? So there could be a scenario that Mr. X is a tax resident of both India and abroad. In that case, what will happen? So once he become a tax resident of India, 195 is not applicable. When to check status of payee, resident or non-resident? At the time of payment or at the time of deduction of TDS? It is at the time of deduction of TDS and not at the time of payment. We can stop here, and if anyone has any question, love, till now we can take those questions. We are not audible, love. Unmute yourself.
Yeah, there are a lot of questions pouring in. So should we go ahead right now or should we take it after the session is over? Should we
I
continue?
think till now, whatever I have covered, if you feel there is some question which pertains to those topic, we can discuss.
Yes, then let me jot it down. Wait a minute.
So you are able to read the questions, love, where those
Yes.
questions are coming?
Yes, I am able to read it.
It's in coming in
Wait a
chat.
minute. Yeah. Wait a minute. From the chat. Sir, are you not able to see the chat box? Yeah. Now I am able to. Wait a minute. Sir, Mr. Chandradev Bhatt has multiple questions. So, Mr. Chandradev Bhatt, it's a long drawn question. So, will it be convenient for you to unmute yourself and speak out the question, or should I read it out?
See, I'm not able to see chat. So how you are able to see chat?
Sir, sir, should I give you the technical team's number? They will share you. Are you not having that means portal by which this can be viewed?
It is coming, but it is coming blank. So tech support host, let me see, committee.
Should I read it out to you?
I think they have not. हाँ, read करो please.
अच्छा, मैं करता हूँ. See, there is one question from Mr. Abhishek. This TDS on dividend paid on Indian company to foreign holding company where it is not having permanent establishment in India.
So yes, TDS would be applicable. So till now, what we have covered, whether
Yes.
the income is chargeable to tax in India or not. So we'll come to dividend later. Any point,
Okay.
Till now, whatever. So, Love, what you can do, I think, if you have my WhatsApp, or you can email me the questions, because until
Okay,
as
fine.
I see the question, I may not be able to answer. Well, there could be a
Yes,
lot of questions which we
yes,
are
yes, there are
covering
lot
or
of
not
questions.
covering.
Right.
आप एक बार बोलो ना उनको टीम को कि why I am not able to see the questions.
Let me tell them. Okay, please. Or should I read it out to you?
और फिर choice of questions में फर्क हो जाएगा ना कि which question I am covering later. So we're going to spend time on that.
चलिए, wait a minute. Let me ask them. Share it with you.
So we can take exchange rate, TT buying rate, SBI for the purpose of conversion rate adopted by SBI for buying such currency should be considered. What if payer forgets to deduct TDS at the time of provision? Now, in some treaties, there is the word paid is written. So in these cases, the court has upheld that being treaty talks about the word paid. So the provisions would not applicable at the time of, TDS will not be applicable at the time of when Indian entity is making a provision. It would only be applicable when the actual payment has been done. So there are, both Bombay High Court and then you have Mumbai Tribunal, and recently Delhi Tribunal also has upheld the significance of word paid in the treaty, specifically from 195 perspective. But now, practically, I personally say this, that this should be used when there is some lapse. But otherwise, we should follow 195.1, that is whichever is earlier should be followed. That is more, systematic. What if NR does not have a PAN? We have a section 206AA which talks about a PAN. We got a rule 37 BC that if PAN is not there, no issues, one can submit the TRC along with Form 10F, and accordingly the TDS would be deducted and no higher rate of taxation should be applicable. Furnishing of information under section 195(6), that is Form 15 CA CB. So rule 37 BB is there, and it is applicable both on taxable and non-taxable transaction. There is an assumption that if you are making a payment through LRS, it is not applicable. What is not applicable? 15 CB is not applicable. But TDS provisions are still applicable. So 195.1 is still applicable, 195.6 may not be applicable. If chargeable, if the amount which you are making is chargeable to tax, and if the amount is less than 5 lakh, then what you need to give is only part A of 15 CA. If amount is chargeable and amount is more than 5 lakh, then what you need, if certificate or order under section 197, 195.2 and 195.3, part B of form 15 CA, if you do not have the lower withholding certificate from the officer, then you need 15 CB. In such case, part C of 15 CA needs to be filled. So 15 CB plus part C, and wherein you have lower withholding certificates plus part A. And if it is chargeable but less than 5 lakh, part A. So ABC. And if it is not chargeable at all, then it is part D of 15 CA.
Sorry to interrupt you. I think the link has been sent by the technical team to you.
On the mail.
Yeah. No, they have sent you the link.
Where you
Are
have
you
sent
able
the
to
link?
probably on your mail? Is it visible? No.
Just wait, let me check.
Okay.
No, friend.
Wait a minute. Let me WhatsApp it to you.
I have received on, I think.
Wait a minute. Let me WhatsApp it to you.
I've got the link. I'm just logging into that. So we have a question from Abhishek. TDS on dividend paid by Indian subsidiary to foreign holding company no P in India. In such case, Abhishek, if dividend is taxable in India, we'll go to section 9, but we can discuss right now that dividend is, if Indian company is paying dividend is taxable in India. Now you need to see whether they are giving you tax residency certificate or not, along with Form 10F. If they are giving you tax residency certificate along with Form 10F, then the treaty, you can apply the rates in the treaty, tax rate in the treaty. If tax rate in the treaty you cannot apply, you will apply the rate in the act. Can I watch it later? I don't know. We have a question from R. Venkateshwaram. The question is, any threshold limit is there for TDS under section 195? Answer is no, there is no threshold limit. Then we have a question from Abhishek Sharma ji. He is joined from Central Region. It says, need to pay commission to a company at Japan against order given by it to supply machinery to company C at India. Okay. Order C given to company B in India. Okay. Now company B will pay commission to company A at Japan. What should need to pay commission to company A at Japan against order given by it to supply machinery? So what I'm assuming, there is a company A which is based out of Japan. Now that commissioner, that agent has, now in this case, what is happening, friends? Very interesting scenario. Now we have a case that we have a company, our commission agent is based out of Japan, and we are a company in India. Now Japanese agent is giving us an order not for Japan, but for India. Not for Japan, but for India. Now, whether TDS should be deducted. So now the sales would be happening in India, and from there the commission would be getting generated. So one can always argue that in this case, the income is accruing in India. And if it is accruing in India, it will qualify as a business income or FTS because there are separate rates. I think one may apply the business income. that, it's a business income. But Abhishek, the better proposition could be, we may apply the Japanese treaty. We may take tax residency certificate and Form 10F, and instead of getting it taxed under Section 5, take it to Section 90, give the benefit, because if company A does not have a permanent establishment in India, the business income is not taxable. You can take that position. Then Raman Sasdevaji from our northern region is asking, please explain Form 10F also. I think I have already answered this question.
Right, sir. Yes.
Sakshi Gargji is saying from our northern region, can we have recording? I am not sure.
Yeah.
Recording,
Yeah.
many people are asking whether the recording would be there or not.
Sir, actually, I'll ask the CMP people to send the. Actually, I think people are sending their mail IDs to us, so I'll ask the to coordinate and send this to the respective mails. Yeah.
Okay.
Then there is another question from Mr. Chandradev Bhatt. Can
So
an NRI claim?
I'm seeing the question. Allow me.
Okay.
On this long-term capital gain, we have already discussed. So I'm not
Yes.
taking right now. TDS should not be there as goods are sold outside India. I think Ankit must have answered this from another region. These are some of the answers.
Yes. People have been.
Is there any way to verify PAN details, that if he is resident or not? From PAN detail, I think it would be tough to verify because it may be showing the record for the last year. So you need to put slightly more efforts, Chirag, in order to find out whether one person is resident or not.
I don't think there is any provision in the Act wherein we can ascertain as to whether he is an NRI or a resident.
Okay, so now I think let's move on with this few questions that we have taken. And later on, we can discuss the remaining questions. $197, we have broadly discussed that, we all know it is a certificate for lower withholding on nil TDS. Both can apply for this, payer or payee. This is a smart table. 195.2 payer needs to apply it. 195.3 pay needs to be applied. 197 both pay and payer can apply. 195.2 for determining taxable portion from the total sum to receive sum without deduction of tax, and then 197 to receive sum without deduction of tax or lower deduction. Payment covered under 195, 195.1 and all appealable. 195.2 is appealable, 195.3 and 7 are not. These are some online forms, revision possible in all cases. Now we are coming to most interesting portion of this presentation, wherein a lot of us get stuck whether the transaction is taxable or not. Deemed to accrue rise in India, and the first is business connection. Now how, because we have another 40 minutes left, and the topic is big. Institute runs a diploma course on international taxation, and I must say that is a good course if you wish to have a good experience in the field of international taxation or the non-resident, along with transfer pricing. I would suggest that you should join, all of you should join that diploma course on international taxation. That will give you a very...
When it has been launched?
Come again?
Sorry. When it has been launched?
It's a direct tax committee keep on launching that course, both physical and online. So one needs to keep track of direct tax committee.
Right.
But it is certainly a very good course. Earlier, they used to have a certification program, which later on got converted into diploma. And I think it is for some 20 days, 10 days, 10 days on international tax, 10 days on transfer pricing. One gets a very good coverage of the topic. So if you wish to do expertise in international tax, or if you wish to build your practice area in international tax or transfer pricing, I would recommend to kindly keep tracking of Direct Tax Committee when they are launching that course. Now, what happens, coming back to section 9? Section 9, we can say there are two types of incomes: passive income and active income. Now, as far as passive incomes are concerned, they are always taxable in the source state. Passive income, let's say your dividend, interest, capital gain, these are all passive income. They would be taxable in source state. That is, if from India we are paying a dividend, from India we are paying an interest, from India we are paying a capital gain, until there is some beneficial clause in the treaty. But in general, those dividend, interest, and capital gain would be taxable in India. If you are paying royalty, it would be taxable in India. Now, as far as active income is concerned, active, for which somebody is working. Active income, we can again divide in two parts, two categories. Fee for technical services. Fee for technical service is an active income. But fee for technical service is always taxable in the source state under the Income Tax Act without going into the TTA. All these are taxable under the source state. If from India you are paying FTS, if from India you are paying a royalty, if from India you are paying a dividend, if from India you are paying an interest, if from India you are paying a capital gain, it is taxable in India. Now, other active income, we classify them as a business income. Business income is taxable if you have business connection in India. If you do not have business connection in India, and if that business income is not accrue or rising because of business connection in India, it would not be taxable. So there must be a link in that business income and business connection. So any income which is pertaining to business connection is taxable in India. Question comes, what is business connection? It is not defined under the Act, except, agency business connection, you will find a reference that under following scenarios, which primarily covers an agent, it would be deemed that there is a business connection in India or significant economic presence. It's a very interesting topic. We're going to touch on this. But what is business connection? So because taxability is on the revenue side, on the income, so business connection must be pertaining to income. So a business should have connection in India through which income is getting generated. This is how I see it. A lot of judgments you will find, and R.D. Agarwal is a landmark judgment in this matter. So what business you are doing in order to generate an income, in order to complete the transaction of generating an income, there should be some connection who is sitting in India, that physical connection. And that connection, if is there, it will call it as a business connection. I often take an example. Let's say on a highway of 150 or 200 kilometers, you are traveling. You have started from your home. After driving for, let's say, 40-50 kilometers, you're on a countryside, and you have started seeing that billboards, which will say, I know a lot of friends have joined from across India, and I'm very happy to see members have joined from across India, from southern region, from eastern region, from central region, from northern region, from western region. So in northern region, we call the eating joints on the highway as dhaba, DHABA. I don't know what you call it in southern region, but in northern region we call it a dhaba. Now our northern region's dhaba, now 5-star properties, they have made a lot of money out of it. But so for the purpose of example, when you are traveling, you will find that after 40-50 kilometers, when you are on a countryside, there's a billboard come. It will say, do come and eat tasty food. And then you will, after 20 minutes or 30 minutes, another billboard will come, will say, do not miss. We have very tasty chole bhature. We have very tasty sambar vada, for example. We have very tasty Amritsari naan. Do not miss. So your mind and heart will start saying, I must stop at that dhaba, that restaurant, that food joint, and must enjoy the Amritsari kulchas or chole bhatures or, some South Indian food. And yesterday I was in Mumbai and I must say, vada pav. Vada pav was such a tasty thing. So 40, and eventually you are on the 100 kilometer and there is a dhaba, that eating joint is there. You will stop your car, you will go, freshen up and order the food, whatever you want to have. So question comes, where the sales are happening, where the revenues are getting generated. Is it on the first billboard, which came at 40 kilometers from your home, or the second billboard, which came at 80 kilometers from your home, or when you're finally at the destination, that is the 100 kilometer from your home? So first two billboards are only a marketing support. The first two billboards are only marketing, creating awareness. One may call it preparatory and auxiliary activities. But where the sales are happening? Sales are happening on the 100 kilometer when you are actually in the dhaba, in the restaurant, and when you have ordered. So there the sales are happening, there the business connection will come. So if you have a person in India, and if that person is supporting you in making the sales, actually affecting the sales, then that person will be called a business connection. Business connection term is unique in our act. If you go to the treaty, tax treaty, we have a permanent establishment. So let me take you to business connection. All income accrue rising, whether directly or indirectly, through or from any business connection in India, or through or from any property in India, or through from any asset or source. So we are on business connection. Then there are certain exemptions. No income shall be deemed to accrue rise in India to him through or from operations which are confined to the purchase of goods in India for the purpose. You will find, there are exemptions with regard to news agencies, non-resident exporters, non-resident filmmakers, foreign diamond shipping company. So business connection, if you have some person in India which is actually supporting you in making sales and not just doing the marketing, then probably it will fall under the definition of business connection. So you have a conclusion of contract, has the habitually exercises, has the authority and habitually exercise such authority in India to conclude contracts in India on behalf of the non-resident, habitually conclude contracts in India, plays a key role in leading to conclusion of contracts by the non-resident, contracts in the name of the non-residents. So not only it's about, that I'm not, sometimes we discuss with the taxpayers, they say we are not signing the contract. But if you're not signing the contract, but let's say if you are playing a crucial role in signing the contract, then also there is a high chance that you will become a business connection in India. So all your efforts, sometimes what happens, let's say we have negotiated the contract, but the signing is done by the foreign company. Then also you will become a business connection in India. So it's now not only about signing of the contract. It's more than that. And now we have a significant economic presence also through explanation 2A. I think this is slightly new, but very important. So what happened, all our tax systems, if you see, it is based on brick and mortar model, that one needs to have a physical presence. This is the way the businesses were done earlier, that you must have a physical presence. If I wish to come for an advisory, now, at the earlier times, I must travel to Chennai, Bombay in order to work. But today I can do a Zoom meeting and, do a Google meeting and give the opinion and provide the opinion on an email. I need not travel. And today, if you wish to purchase a product, you can simply go online, see the product details, make a place an order. But earlier, you'll find there used to be some Diwali Mela or trade fair there, wherein the for suppliers will come from outside state or outside country. They will put their banners, they will put their stall, and they're making the sales. They will have some agents in India. But now things have gone online. There is a digitalization. Now you need not travel to buy. You need not travel to do business. Today, you and me, we must be having a lot of clients which are based out of your city, out of your town, maybe out of India. And you can simply give them advice and you can deal with them through online. Earlier, when we used to have seminar, one used to travel physically. But now, through the webinar, more than 500 or 600 members are watching this from comfort of their home or office. They need not travel. So this digitization has led to significant base erosion and this worried various tax authorities. So OECD, along with the different countries, G20 and other countries, almost now 130 to 140, they started a project, base erosion and profit shifting. And they released a 15 action point with regard to those projects. And the very first action point was taxation in digital economy. How to collect a tax, how to save a base when how to save a tax base when everything is getting digitally, people are going online to sell. So they suggested 3 measures. One of the measure was significant economic presence. Another measure was equalization levy. India introduced equalization levy. India also introduced significant economic presence. Now, the first question comes whether the significant economic presence is only applicable on the digital sales. The answer is no. If we see the earlier version of significant economic presence, I think which came through Finance Act 2018 and later on amended. So in earlier version, there was a word digitally, which is missing in the updated version. So in my humble view, significant economic presence would be there, even if physical sales are happening and not only the online sales. And what it says, business connection in India and the significant economic presence for this purpose shall mean transaction in respect of any goods, services, or property carried out by a non-resident with any person in India, including provision of download of data or software in India, if the aggregate of payments arising from such transaction or transactions during the previous year exceeds such amount as may be prescribed. Now, if the non-resident makes the sale in India, let's say non-resident is based out of Singapore, during the year he exported goods worth rupees 3 crores, then one can safely say that such non-resident has got a significant economic presence in India. One may say, no, aggregate is 3 crores, but he made 10 sales worth rupees 30 lakhs each and all to 10 different customers. In that case, what should be done? Should we see 30 lakhs or we should see the aggregate amount? In such case, you will see the aggregate amount. The challenge comes that you are issuing 15 CB for one of the party, and that party comes to you. That Mr. Venkataraman, kindly issue the 15 CB. They do not have any permanent establishment or business connection in India. The amount is only 30 lakh. You say, oh, it's a purchase of goods. They don't have PE. They don't have business connection. So let's close the matter. Let me issue the 15 CB certificate. But sir, are we aware what is the aggregate volume of transaction that party has done in India? Or you are only aware about only the one party which you are handling? I think now you must ask what is the total amount of sales you have made in India. He may say, no, I will not disclose this to you. Why I should tell? Or he may come to you and say, look, I have got a 3 crore transaction worth amounting to rupees 3 crore transaction with India. There are 9 other customers in addition to you during the year. Then you will say, boss, now you have got a significant economic presence in India. And because you have got a significant economic presence in India, you have got a business connection in India, and your business income attributable to this transaction would be taxable in India, attributable to sale of machine. Now, what is attributable is a question for which we need to find an answer. Out of 3 crore, whether 10%, 20%, 30%, what should be attributed? Something which you need to find out. But amount, not the entire amount, but the amount attributed. Question comes when you are making a payment, when your client is making a payment, does he need to deduct the TDS? Answer is yes. If it does not have TRC and if it does not have a data, what is the total amount of sales the non-resident party has made in India, in my humble view, we will take a conservative view. And according to conservative view, we will assume that such party, if he is not disclosing other sales, one may say that he has got sales more than 2 crores rupees in India. And if it is more than 2 crores, the threshold limit is 2 crores. If it is more than 2 crores, then I will deduct TDS because you have not shared any information. I will go as per my conservative view and going to withhold the TDS. Rate question is at what rate? So as per the budget, the rate is 35% plus surcharge. So you will going to deduct the TDS at the rate of 35% surcharge on the entire component because you are not aware of the breakup. You are not sure what should be the attributable amount, what should be the chargeable to tax. Either you will take a lower withholding certificate, but in that case also you need all that information. So the best view would be that there should be a cooperation from the foreign party, and foreign party should submit tax residency certificate and Form 10F. So once they will submit you the tax residency certificate and Form 10F, you can comfortably take them to the treaty. And in treaty, we do not have significant economic presence till now. And you will say, you will check then only permanent establishment. If permanent establishment is there in India, one needs to withhold TDS. If permanent establishment is not there, no requirement of withholding TDS. It is as simple as that. The another para B, systematic and continuous soliciting of business activities or engaging in interaction with such number of users in India as may be prescribed. That is 3 lakh users. So not only, when we are supplying goods or services or any other transaction, but also if it is an online system, online business, wherein there is a systematic and continuous soliciting of business activities or engaging interaction, your Facebook, LinkedIn, and maybe other online companies, and the number of users are more than 3 lakh in India, we'll say you have significant economic presence in India. But again, this SEP, significant economic presence, is not there in the treaty. It is still not made roots to treaty. So if your client submits you the tax residency certificate and Form 10F of the foreign entity, take them to the treaty. What is P? Before I move on to other points, how to check, whether there is a P or not? Should we simply rely upon the certificate of a non-resident? I think not. We should not simply rely upon the certificate of the non-resident. So P means permanent establishment, fixed place through which business is carried out. Article 5 of Generally Tax Treaties means there is a fixed place, there is some place through which you are doing a business. Some place, because that P wordings, permanent establishment under the treaty is still based on the brick and mortar. So there must be some place which is identified through which one can render services or through which one can do the business. If that place is there in India through which you can do the business and through which you are earning the income, most likely it will become a permanent establishment. Then it is called fixed place P, and then you will find there a list given, branch office, a project office, and then a lot of things are there. Then you have a construction P. If you are involved in construction activities in India, or if you are involved in supervisory activities in India, you could have an agency P, but dependent agent P more. If you are not dependent upon a particular group, then you generally fall under dependent agent P. So we have different permanent establishments. So you will check whether you are becoming a permanent establishment, you have permanent establishment in India or not under these clauses. So what you can do, you know what, this I tell to everyone, that ask your client how he's procuring goods from the foreign client, foreign company, how they are negotiating, where they are negotiating, with whom he is meeting, whether it's some Indian person, non-Indian person. You can always check on the website whether the website of a foreign entity is showing that they have got any office in India or not. I think such, that such exercise must be done by a chartered accountant. I personally feel. Though client should deal it, but client should do this, but we can guide client to carry out this activity so that we are pretty sure that whether at least the sanity check, I will say, it's not, we cannot do the investigation, but if something is available on the Google, whether if client is meeting through some Indian person, whether the Indian person is an agent or not. So all that information can be collated and, one can conclude based on the declarations given by the foreign entity, plus the sanity check that we have done, whether there is a risk of PE in India. This was on the business income. Now going back on the other parts, we still have time. Now, fee for technical services. I said fee for technical service is an active income, but it is taxable in a source state. So fee for technical services, royalty, both these two are taxable at a gross rate. What is the cost of providing services does not matter. If something qualifies an FTS, it would be taxable at a gross rate. If let's say I'm paying $100 to the foreign entity, on $100 I will collect a tax. FTS is broadly of three types: managerial, technical, and consultancy. Managerial means someone, who is managing something for you. Simply not following your orders, but also lending some good support. Managerial. Technical, which requires certain level of expertise. Consultancy, we all know that giving counseling or consulting someone, giving advice. All these three elements, managerial, technical, or all these three, type of services, managerial, technical, or consultancy, are clubbed and called technical services under the Act. But you will observe that all three services have a human element. The one who is managing, the one who is giving you technical service, the one who is giving you consultancy service, all these three have got a human element. So until some human is involved in rendering you a managerial service or a technical service or a manager or a consultancy, it will not qualify as an FTS under the Act, and there are a lot of favorable rulings. So there must be human touch in the nature of managerial, in the nature of technical, or in the nature of consultancy. And if that is the case, you will, the payment will fall under the category of FTS. But under treaty, there are very interesting situations. Now, under the treaty, you will find we have a called fee for included services. In short, you will find that there is a make available clause. What happens in make available clause? That there is an additional requirement. In Hindi, we call it saksham karna, make available. I am making available you the technology so that you can do it yourself. So I have given a technology to you. Now you can do it yourself. So that will fall under technical service. So now if you are coming to me again and again for the services, then I have not make available you the technical service, because you are coming again and again to me. In such case, it will not become taxable under the treaty. So few common treaties have written. Now, if let's say you are receiving, you will see that many a times companies, headquarter their management office either in US, UK, or Singapore, and they try to bill it from US, UK, or Singapore. Why? Because in all these treaty, you will find there is a make available clause. So if you are receiving a management services from Singapore, they take a position that it has got a make available clause. So management services is taxable under the Act. Managerial service, they are taxable under the Income Tax Act, but it is not taxable under Singapore Treaty because of the make available clause. One will say, and there are a lot of courts have clearly said it is not taxable because Singapore company has not given you make available you a managerial service. They have not adequately given you all the band and widths to do service yourself. Whenever you need me, you need to come back to me. It is like going to a doctor. Doctor will write a recommendation that this medicine you should buy, but they have not. And certainly, when you will have some common problem, you might go to the same chemist, to a chemist with the same recommendation and buy a medicine. But still, doctor is doctor. They have not given you the medical knowledge. So that is there in some of the treaties you will find. The another variation is sometime out of these three limbs, managerial, technical, consultancy. Technical always would going to be there. You will find that either the word managerial or the consultancy is missing. In such case, the definition is squeezed to two, either managerial, technical, or consultancy. That is also you can check in the treaties. So there are different treaties, and different treaties you may find a different wordings. But what I'm telling you, commonly these kind of things you will find. Then sometime what happens, the article with regard to FTS is missing. You will not find any article in the treaty which talks about FTS, fee for technical service, and what to do. In such case, FTS is treated as a business income, and unless you have a business connection or a permanent establishment in India, FTS is not taxed. Again, we have a lot of case laws on the same. So this was on FTS. Now we have a most favored nation clause also. So if the government of India has notified, through a notification about some nation, MFN clause of some nation, and how MFN clause will work, in that case, you can use that benefit. How most favored nation works, sometime, it narrows down the definition or it narrows down the tax rate. So for example, let's say, if we apply the India-Spain most favored nation clause in some treaty, then the definition of FTS will get reduced. So this is how most favored nation works. Again, a very important thing, it must be notified. Now coming to salaries. Salaries is taxable wherein the employment is exercised. Business income we have discussed in detail. Now on salaries, income which falls under the head salaries if it is earned in India. Explanation for the removal of doubt, it is hereby declared that income of the nature referred to in this clause payable for service rendered in India and the rest period or leave period which is preceded and succeeded by services rendered in India and forms part of the service contract of employment. So to cut short, salaries are taxable where employment is exercised, where you are physically present. If you are physically present in India, salaries would be taxed in India. If you're not physically present, it would not be taxed in India, barring this exemption. So there may be a case that you are a non-resident and you are on the deputation in India, or you are on the secondment in India. Still, you are a non-resident and your contract for employment is with the foreign entity. They are transferring all your salary to your foreign bank account, but you are here in India for, let's say, 3 months. Now that 3 months exercise you have done in India, employment you have exercised in India, and India will get a right to tax for those 3 months, maybe 6 months. We will see there is a short exemption also in the Act, but India will get a right to tax both under the treaty and under the Act. There is a short stay exemption which I was referring to under section 10(6). So we got a right under section 9 that if you have done employment in India, if you exercise employment in India, even if the company is outside India, it would be taxed in India. Many cases, I will tell you one common example. In case of residents, I think that we need to take care. What happens, we have a resident sitting in India, we have a friend or a senior who is working for some foreign company, Canadian company or a US company, but work from home is there. So they are in India for a long period, they are a resident. And salary comes from US to their Indian bank account after deducting a tax in US. Question comes whether the tax deducted in US, one will get a credit in India or not. See, if you see the treaty, the taxing right is with India and not with US in this case. And if taxing right, not specifically US, in general, the taxing right is with India because employment is exercised in India. That person is a resident in India. So foreign country does not have a taxing right. So I think that is something which needs to be taken care, whether one should claim the credit in India or US or the foreign country. That is the question one needs to decide. Now coming back to the non-resident, in the case of individual who is not a citizen of India, the remuneration received by him as an official by whatever name called of an embassy, high commission, legation, commission, consulate or the trade representation of a foreign state or as a member of the staff of any of these officials or services in such capacity. If these conditions satisfied, in general, it would not be taxable. Now, this is the short stay exemption 1064. In the case of individual who is not a citizen of India, the remuneration received by him as an employee of a foreign enterprise for the services rendered by him during his stay in India, provided the following conditions are fulfilled. The foreign enterprise is not engaged in any trade or business in India. His stay in India does not exceed in aggregate 90 days. Such remuneration is not liable to be deducted from the income of the employer chargeable under this Act. So now if a foreign citizen comes to India for less than 90 days, in such case, he can claim exemption under 1064 and he can say, I'm not taxable in India, even though he is exercising employment in India. But that these conditions should be fulfilled, that foreign enterprise is not engaged in any trade or business in India. Means they should not have any business connection or permanent establishment in India. Stay should be of less than 90 days. And such remuneration is not liable to be deducted from the income of the employer chargeable under the Act. We are not claiming such salary as an expense in India. If that is the case, then the salary, even for the employment exercised in India, would not be taxable. Otherwise, in general, if somebody is situated in India, based out of India, even if they are receiving salary outside India, it would be taxed in India. We can skip this just to show you how it is worded in DTA. Subject to the provisions of Article 17, 18, 19, 20, 22. Yeah, let's come here. Salaries, wages, and other similar remuneration derived by a resident of a contracting state in respect of an employment shall be taxable only in that state unless the employment is exercised in the other contracting state. So, if the employment is exercised in the other contracting state, in this case, let's say India, it would be taxable in India. If the employment is so exercised, that is in India, such remuneration as is derived therefrom may be taxed in the other state. Notwithstanding the provision of Para 1, remuneration derived by a resident of a contracting state, let's say Canada, in respect of employment exercised in other contracting, let's say India, shall be taxable only in Canada. So there is an exemption. And what exemption that reads? The recipient is present in the other state for a period or periods not exceeding in aggregate 183 days. So his stay in India is of less than 183. The remuneration is paid or on behalf of employer who is not a resident of the other state. That is, he is not resident of India, employer is not resident of India. The remuneration is not borne by a permanent establishment or fixed base or a trade or business which the employer has in the other state. That is in India. So stay is less than 183 days. The employer is not Indian. employer does not have any business or trade in India. In that case, clause 2 will apply. Now, if you see the exemption, the short stay exemption which we discussed was applicable on foreign citizens, not on Indian citizens. But this para is applicable on tax residents of foreign country. So you may be a citizen of India, but if you're a tax resident of foreign country, you may claim the treaty benefit. But in order to claim the treaty benefit, again, my friends, you need to have form 10F along with TRC. Only then you can claim the treaty benefit. So as the time is running, let me quickly, share a few more important points. That royalty now on software is certainly, because of the judgment of engineering analysis, is not taxable. So what royalty of software if there is an end user agreement? So basically you are not creating copies. You are using software for your own use, but you are not creating copies. If you're not creating copies, then it is not taxable. If you are buying and selling, again, it is not taxable. This is what the Supreme Court said in case of the engineering analysis. And otherwise, if you are, so till the payments are covered under the Copyright Act, it will not get taxed as a royalty under the Act. This is what broadly about the royalty. And now let me take questions. I think we might have questions from members. On capital gain, we are receiving a question that if we deduct lesser tax, the portal will send a notice. I do agree. The better approach would be to approach AO and take a nil withholding certificate. What I told you is law. But yes, if we want to avoid any litigation and if we want to play safe, better to go and take lower withholding certificate. But yes, what I said is absolutely true. Then we have a question from Lokesh. Lokesh ji from our northern region is saying, in case of explanation 2A, that is significant economic presence, the client has not taken TRC and 10F from all the suppliers. How to cover in the audit? Lokesh ji, I am not very good in audit, but yes, you can see there is a tax exposure, there's an increased tax exposure, and to that extent, the financials are not true and fair. So probably one may create some provisions or tax demand or some kind of a note. But yes, if Form 10F and TRC is not there and there is a risk of significant economic presence, one cannot deny the tax exposure in that case. Prashant ji is asking, can you please repeat the applicability on resident but not ordinary resident? I think you're talking about 195. So 195 is applicable on non-resident, Prashant ji. If someone is resident but not ordinary resident, it means he is a resident. And being his resident, it will not get covered under 195. Now we have a question from Rajendra ji from Southern region. Rent received by non-resident of property owned in India is TDS must or exemption can be claimed. If rent is received, then certainly the one who is paying the rent should deduct the TDS. If you wish to claim exemption, I think then depending upon the status of, upon the type of the SSC, whether company, individual or whatever, one may apply for 197 and then accordingly do it. Then we have from SIRC, TNV Rao ji, applicability of section 192, 191 salaries paid by Indian company to non-resident who are working outside India. Can we apply DTA if Form 10F is not uploaded? Sir, as per law, you cannot apply the DTA because Form 10F and TRC both are mandatory unless all the information required under Rule 21AB. If information required under Rule 21AB sub-rule 1 is given in TRC, if all the information required, then only 10F is not required. Otherwise, sir. We have Shubha Hegedeji from Southern Region. India company paid professional fee to non-resident Indian and deducted TDS wrongly under 194J. Can NRI claim TDS credit in his return of income and offer? Yeah, certainly. I think there is, because TDS has been deducted and TDS is payment of advance tax. So now the non-resident can certainly, while filing a return, claim in my view, can claim or should claim the amount deducted under 194J. But I think it may create a problem for the payer.
Yes.
So a lot of members are, wants to have recording.
Yeah. One is Mr.
We have a question from Ravindra Turaga from Western Region. Foreign company deputes his employees to Indian company to supervise foreign company orders who is being paid stay expense by Indian company. The foreign employee is getting his salary in foreign country. His foreign salary is taxable in India since the employee is working in India. I think we discussed, Ravindra ji, this, that if he's not able to get a short stay exemption, you need to see the treaty. Under the Act, if we have a short stay exemption of 90 days, I'm not sure in this question it is more than 90 or less than 90. If it is less than 90, probably, and other conditions are satisfied, you may give the short stay exemption and say it is not taxable. But if it is more than 90, I think then you need to take this individual to the treaty and see the position in treaty, the dependent personal service article, and you can only check that if you have tax residence certificate and Form 10F. So these were the questions, I think, which we can discuss. Let me see. I think I'm done with some questions, the majority of the questions. Lavji, and now over to you for the closure. Thank you.
Okay, sir. Okay, sir. Thank you, audience. I'm very much grateful to you for the nice hearing which you gave. I'm sure the audience must have benefited a lot from your words of wisdom, and it must have brought a lot of clarity on the doubts that you might have arising in your minds. So, with these words, I also thank you so much, Mr. Gaurav sir. I'm also grateful to the CMP committee for taking such beautiful topics and which I'm sure might have benefited a lot of our members in whole. Thank you so much. Thank you so much. Okay. Over to Madam Namrata, if she's available. Otherwise, thank you, technical team. Thank you so much, sir.
Thank you, sir. Thank you.